Hello Share Advisor members, and welcome to another of our educational videos here at Share Advisor. I'm Owen Benelak, one of the advisors here at Share Advisor, and we like to take the opportunity with these videos to take a step back from the busy whirl of investing life, the company reports, the news and that kind of thing, and to think about the strategy of investing, perhaps some of the techniques that will stand you in good stead over the long term. Now today I'm going to talk about portfolio rebalancing. It's an exceptionally exciting topic, as I'm sure we'll all agree at the end of this 12 minutes. But before I get to rebalancing, which is kind of the action shot, I'm going to start with what I mean by portfolio. Now, you might think of a portfolio as a collection of shares. That is, of course, a very good definition of a portfolio. But from a personal wealth point of view, your portfolio has a wider context. Most investing textbooks would say that most investors should have a mix of assets. So you wouldn't just have shares. You would also probably have some cash, and you would probably have some bonds, maybe government bonds, maybe corporate bonds. These are considered less volatile, arguably safer assets. They're not going to deliver the return of shares, but they're probably not going to go down 40% in any one year. Very, very unlikely to in the case of government bonds. And a textbook would say that you would need to have a mix of those assets, and you might even throw more exotic things into the mix. You might have some property funds, you might have some private equity funds, you might have some gold. Yes, I mean you at the back there. You might have some precious metals in your portfolio. I'm not going to judge you. Diversification is the only free lunch, they say, in investing, and having a mix of these asset classes is a good way of kind of weathering the storm. Like when one does well, perhaps another doesn't do so well, but as the years go by, that situation may reverse. So you have a more stable investing life. Now, obviously at Share Advisor, clues in the name, we're concerned with the share advice part of the picture. We're concerned with finding companies that we hope can beat the market over the long term and help you to reach your financial goals. But even if we weren't, even if we were also interested in discussing more minutely cash and bonds and these other asset classes, we wouldn't necessarily tell you where to put your money. And that's because asset allocation is a very personal matter. It depends on where you are in life, it depends what your goals are. If you're a 20-something, maybe saving for a house that you might buy when you're 30, that is very different to even a 20-something saving for their retirement when they're 60. Both situations are very different from a 60-something who might retire in a few years and probably doesn't want to lose half their money in a stock market crash. So you can see that every member is going to be different from that point of view. And also, even if we had two 20-somethings, two 50-somethings in front of us, the fact of the matter is people have a different risk tolerance. Some people have the stomach for investing, some people have the stomach for some investing, some people find investing very difficult, but they know intellectually that they should have some money in shares, but they don't want to push things too far, because the worst thing you can possibly do is assume too much risk with your portfolio and then panic in the midst of a sort of a stock market rout. And believe me, one will come again, probably sooner than we expect. Maybe not for 5 years, no one can know, but one will come again. They tend to surprise. And the worst thing to do is to sell at the bottom, swear off shares, never make your money back, and it would have been better if you'd never started investing. So getting your risk tolerance right is very important, figuring out your goals and where you are in life and the kind of risk that you're prepared to take. Now, how can you do that? There's some rules of thumb. A very old rule of thumb is to have 100 minus your age as your maximum allocation to equities, to shares. And that would be split across different countries usually as well. So we only do UK shares. Some people would like to add American shares, European shares, Japanese shares to their portfolio mix, to their equity allocation. You might do that via tracker funds and use Share Advisor for your UK allocation. But the point is, if you added all that up and you were 30, the most it would come to would be 100 minus 30, 70%. So you would only want 70% maximum in equities. The rest you would put into probably cash and bonds. It's a rule of thumb. It's not a nailed-on law of the investing universe. I, for instance, have far too much of my money in shares by that rule of thumb, but that's because I've been through a couple of bear markets, and at the very least I know I don't sell up at the bottom, so I know that I have a fairly high risk tolerance. In fact, I'm more inclined to want to add. It doesn't make me special, it doesn't make me some amazing person, it's just purely down to temperament. It depends how you're wired. If you are 40 years old and you do that maths and it says you should have 60% in equities and you think, you've got to be joking, I'm not going to lose half my money in one really terrible year, that's perfectly acceptable. Don't put 60% in equities, put 20% in. The thing to do is to, it's a Sunday afternoon, perhaps it's raining outside, you put Radio 3 on, and you think very soberly and cautiously about how much risk you want to take. You create an allocation that you can take forward into the long term, tweaking as you age, as you get closer to that retirement, and then you stick to that plan. That's the important thing when it comes to asset allocation. Okay, so you've worked out your asset allocation in the cold light of a December day, shall we say, but the stock market might have other plans, even the bond market might have other plans. You've decided perhaps that you should have 60% of your money in shares and 40% in bonds. But stock markets tend to soar and they occasionally crash, and even bond markets can wobble around a bit. Gold, you might think of that as a very safe asset, but that's tripled in a decade and then gone down by a third. So all of these assets are volatile. So if you've created your asset allocation and then the market gets on and does its thing, it's going to kind of drift away from what you had initially allocated on your rainy Sunday afternoon. And the important thing here is that you created that plan on a very dull day for a good reason, which is that you were not trying to be influenced by your emotions. But when the market is soaring, or when the market is crashing, emotions come very much to the fore. So what you find a lot of people do is in the bottom of a deep bear market, they start selling, or they sell half their shares, they say, I'll wait till things get better, some nonsense like that. And then they never see things getting better, they sit there in their cash for 3 years. After the market's gone up 40%, 50%, 100%, that's when they start to think about their asset allocation again, and that maybe they should have more in shares. That's when they buy, so they've not captured a lot of the gain in the stock market. So it's very difficult to work against your emotions. Most investors find it hard, even the savviest have rules to make sure that they stick to their plans. So rebalancing is a good way of sticking to your plan because you make the rule automatic. What you do is you say, I've got this allocation, it might change a little bit over the years, maybe every year I'll have 1% less in equities and 1% more in bonds, just to take into account the fact that I'm aging. But in general, I'll stick to those percentages. So let's say you had a percentage allocation of 60% in equities and 40% in bonds. That was what you decided would do you good for the next decade, say. Now the stock market goes up a lot, you don't get carried away, sell all your bonds and invest in the stock market. Stock market crashes, you don't sell all the rest of your shares and seek shelter in cash. What you do is you very soberly, probably once a year, look at where your various assets have moved and you rebalance. You sell the ones that have gone up to bring them back down to the level that you'd set, and you put the money raised into the ones that unfortunately plummeted. Generally, if one goes up, another one will go down. In fact, if you haven't got something going down, your allocation is probably not quite diversified enough. So let's say you had £100,000 and you divided it by 60% in equities and 40% in bonds. So the first year you've got £60,000 in equities, £40,000 in bonds. Remember, I'm not talking specifically about how those are invested. That would be a whole load of other videos. Let's assume a fair few of them are in Share Advisor shares as we're here. But after a year, the equity market, your equity portfolio has gone up by 20%. Good times. People perhaps were feeling a bit more confident, they sold their bonds, and the bond market dropped by 5% that year. So if you do the maths, 20% on £60,000 will take you to about £72,000. That's nice. Your bonds have fallen by 5%, they're now about £38,000. So what's happened there is you're now taking more risk because you've now got £72,000 in shares and £38,000 in bonds. So 60-40 has gone out the window, you're moving away from your targets. So what you have to do is you add the two together, that would come to 110,000. You would work out what a percent of that is and you would find out what your allocation would be to take you back to 60-40. So I can quickly do the maths that I've obviously thought out in advance, and you would basically be looking at having £66,000 in equities and 44,000 in bonds. So you would sell sufficient equities to take you down to 66,000, and that money would move over to your bond fund, maybe a bond ETF or something like that. So now you've still got the 110,000. You've still got more in equities than you had at the start of the year, but you've trimmed some of it and you've added to your bond fund. And you might do this year after year, and it might feel for a while that it was a pretty disastrous thing to do because you're continually trimming your winners from the assets that's going up. Sooner or later, though, there will be a reversal. It happens very quickly when it happens in the stock market, and then you'll be very happy because let's say one year maybe you've got to 100,000 in equities, I haven't worked out what that is in the top of my head in where you'd be with the bonds, but let's say you've got some amount in bonds. I'm not going to try and do it on the fly. The stock market falls by 50%. It's a disaster. Except you've been putting all this money across into your much less volatile bond fund, so you know you can sell down some of those bonds, move it back into equity, so that's where it's paying off for you. So over the long term, it's probably not going to be the strategy that delivers the very highest gains, because the very highest gains will be delivered by the asset class that does the very best. Most of the time that's going to be shares. It's not absolutely nailed on that it won't actually do slightly better than if you just invest in shares, because this very active rebalancing can actually generate returns. It's a sort of a quirk of economics. But what will happen is your portfolio as a total will be less volatile. So you're getting a better risk-adjusted return. You're not suffering as many deep sort of drawdowns in the stock market as someone who's only in equities. Probably not going to have quite the same highs, but you're going to have plenty of highs along the way. The important thing is that this is going to keep you sticking to the course, because you've got a plan, you know your risk tolerance, you keep dialing back to stick to that risk tolerance, and over the long term that should stop you panicking and that should get you to your goal.